Let's move on to look at housing because a new report highlights the amount of equity that U.S. homeowners lost on their homes. The average mortgage holder saw a $5,400 decline in equity in the first quarter from a year ago. Borrowers in Western states posted the largest losses. Joining us now for more is Selma Hepp. She is Corelogic chief economist. Selma, good to speak with you. In percentage terms, U.S. homeowners saw home equity fall by 0.7% in the first quarter. Is that a lot? Is that a little? How do you gauge the degree of decline there?
Well, let's put it this way. Average home equity right now is at $274,000 per mortgage borrower. So while it has declined, it's really declined only marginally. And when you look at where we were prior to the pandemic, on average, folks had about $182,000. So we are up a little of almost $100,000 in equity, despite these little losses that we've had.
Right. I guess the question for so many people is, it declined by 0.7%, which, as you say, is not a lot. But is this the beginning of a longer slide of more declines to come?
Yeah, that's a great question. I could say at this point it's not, because our most recent home price index data show that home prices are increasing again, and they actually posted a really strong monthly gains in early spring months of this year. So with that in mind, we are actually up from the fourth quarter of last year to the first quarter of this year in terms of home equity gains. So they're back up on an upward path of having those equity gains.
And so let's go into the geographic sort of shifts here. Western states falling. You see Florida holding up. Is that surprising, and how sustainable are some of those shifts?
Well, so home prices in Florida have remained, home price growth has remained pretty elevated. It has peaked similar to the other markets, but it has taken a longer time to decelerate in comparison to some other markets. On the West Coast and West Coast markets, we are seeing larger declines. So there are a couple of things going on. One is that, those are more pricey markets to begin with, so mortgage rates did play a larger role here in leading the declines. And the other thing is the affordability is much bigger issue in those markets. But again, going back to our home price index that we were just releasing over the last couple of months, it did show a rebound in all of these markets. So all the markets are now seeing pretty strong price gains once again on a monthly basis.
And of course, we're having this conversation against a macroeconomic backdrop where it still feels like there are recession calls out there, that is the consensus. Maybe they've been pushed out, but you think about recessionary periods. What do prior episodes of recessions tell us about how home equity actually performs in those periods?
Right. Well, the one that most people tend to benchmark things against is the Great Recession. And during that period, the share of homeowners that went into negative equity went as high as 26%. At the moment right now, we're only at about 2%. And with these price declines that we've seen up until this point, that share has only increased about 10 basis points. So really not a large increase, and quite a bit still a difference between the 26% getting out of the Great Recession and 2% now. For us to get to that 26%, we would have to see home prices decline by some 40%. And that's really an unlikely scenario in this case. I mean, in our Corelogic home price forecast for this year, we have home prices going up about 4% for the year.
Yeah, that's a far cry. So, of course, what makes this time different, of course, is that homeowners are locked into really low mortgage rates. They may not love their current home, but they love their current rate. What would it take to unwind this embedded mortgage rate lock and normalize inventory? Do you think the 30-year fixed rate mortgage needs to get to a specific level? Is it, I don't know, a certain rate for unemployment that changes things?
Well, I think there are a couple of things. One is the environment of 3% mortgage rate is very recent in many ways. It's only been a year since we last had those rates. And so we have to get away further from that 3% rate for people to start feeling comfortable again where mortgage rates are. The other thing is there is this magic rate of about 5.5% that people perceive to be a rate at which they would give up that really, really low mortgage rates. So we do still have some time to go before people get more comfortable and you give up the inventory.
Yeah, so for people who are looking to buy homes, it means you got to keep being patient.